So we're definitely at the point where now the Fed has to try and crash the economy. They have to try to get people laid off, to raise the unemployment rate, because there's just no other option to get people to stop spending. Now, if you're a fan of this channel, you know that we've been talking about these events, these macroeconomic events for years, and I try to keep you as up to date as possible on them. But for those of you that are new to economics, new to finance, you might not understand why that's the case. Well, the Fed controls the money supply, and the stock market itself also has a very unhealthy addiction to the Fed. We've talked about that before in this channel. We'll talk about it a little bit in this video. But in this video, I'll tell you what to watch out for, because what's going to happen within the next couple of months here towards the end of the year is something that all Americans should really, and really citizens of the world, should really be focused on. The unemployment data already came in lower than expected. This on its face might seem like good news to you. This is actually very bad news as it relates to Fed policy. Again, we'll talk about why, but in my last video, I said that if unemployment comes in lower than expected, the market will tank. Lo and behold, the market did start tanking right after that unemployment number came out. And we also have CPI releasing on October 13th, which is the inflation report for September 2022. I'll tell you exactly what the market is expecting and how we're going to be trading this as well based on historical market data. Are we finally going to see earnings compression? Let's get right into it. So let's start with unemployment. Earlier this week, unemployment came in at 3.5%. This is not good news. This is bad news. Yes, it's great news that there are less Americans unemployed. But from the standpoint of the Fed, from their viewpoint, not from my viewpoint, a few of you did get a little bit testy with me in previous videos when I said that the Fed is trying to break the labor market and they want unemployment to go up. I'm not saying that. This is from the Fed standpoint, okay? And I'll show you proof of that if you don't believe that that's what the Fed is doing. This is not a conspiracy. This is the real deal. Powell says job market will have to suffer for inflation to fall.
We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done.
Those are the words of Powell.
Made in America is
what the hell
making
is going on? Shut up. Those are the words of Jerome Powell, not mine, right? Jerome Powell was saying that the labor market will have to suffer in order for inflation to fall. That's not what happened earlier this week. Now, I want you to take a look at this graph here showing the unemployment rate and the recessions here highlighted in gray. What happens every time we have a recession? We have a swing low in unemployment, and then once it starts ticking up, that is when we officially fall into a recession. And right now we are at a historic low in terms of unemployment. Now, when it comes to recessions, a lot of times they are Fed driven, especially since the implementation of the Fed. The Fed is trying to break the economy in order to lower prices. This is very similar to what we saw in 1980. So for those of you that are sharing graphs between 2008 and 2020 or 2000 and 2020, this situation is nothing like 2008. It's very much closer to what happened in 1980, where we knew that a recession was coming because the Fed was raising rates aggressively in order to try to force a recession. In 2008, nobody knew, besides a few people, nobody knew that nobody felt like we were going into a recession. Yes, there were some warning signs here and there, but no one knew where the break in the system would come. And once these banks like Lehman Brothers that were too big to fail actually failed, then that started, knocking over all of the dominoes in front of it, and we actually fell into a recession. In this case, the Fed is preemptively telling you that they are trying to force the economy into a recession, not only with the job market, but here you even see Powell's remarks on the housing market. Powell warns of correction in once red-hot housing market. The Fed chief says U.S. property price gains were unsustainable. Good thing for prices to decelerate. So not only is he trying to force a slowdown in the housing market, which is already happening, but he says that we need to force unemployment to go up, which is not happening, which is why the market is tanking on good news. Now, the reason this is bad is because it means that the Fed is going to have to get more aggressive with their Fed rate hikes. See, I want you to think of this very simplified formula here. When the Fed increases rates, right, that makes it more expensive for the economy to do anything, whether that's spend, borrow money, build businesses, expand businesses, etc. So productivity eventually goes down, which also then brings stock valuations down because there's less spending. And so companies are now reporting less earnings. Also, a lot of models that are used to evaluate companies are based on things like discounted cash flows. What is the present value of future cash flows for companies? And the more expensive money is, the higher that the rates are, right? The more discounted those cash flows are today. So the higher the risk-free rate is, the more discounted the cash flows are, the less valuable these cash flows are. So that is why stocks tend to go down, especially growth stocks, when the Fed funds rate goes up. So there was an expectation or a hope that the Fed would actually lower or stop raising at least the Fed funds rate sooner. But if unemployment is not cooperating, and if CPI, which we'll talk about in a second, the consumer price index, which is what measures inflation, if inflation comes in hotter while unemployment is lower, this is going to cause the Fed to say, fuck it, we're going to continue raising until the end of time. And the end of time being until inflation actually drops. If you look just a month ago, there was only a 10% chance that the Fed was going to do 75 to 100 basis points in the next meeting on November 2nd. That's when the next meeting is, right? However, now that unemployment came out hotter than expected, meaning lower, and the job market is stronger than ever, now that went from 10% to 78% likely that the Fed is going to do a 75 to 100 basis point rate hike November 2nd and will likely continue on further and further through 2023. Here you could see the Fed's dot plot. 12 of the 19 Fed members think that the federal funds rate, the target rate, is going to be between 4.5% and 5% by next year. This is a lot higher than we initially expected. Now, before I get into further data points, because there's one extremely dangerous data point that shows, at least to me, that we are not done breaking yet in terms of the markets and the economy. And I'll show you exactly what that is. But a lot of you have been asking me, how are you going to trade the CPI data? Well, I took a look at all of the CPI events that happened this year, and every single one was a down market except for August, which was July's data. So the CPI report that came out in August was about July, but that was the only month where we showed an unchanged month over month inflation rate, which is why the market reacted somewhat. It lasted a very short time, but somewhat favorably to that report. Otherwise, every single CPI report this year has come in negative. As a matter of fact, 18 of the 19 last CPI reports came in higher than expected. You'd think that they just at least overestimate the next one just for fun. So here's what's currently expected: 8.1% year over year. CPI increases to 0.2% month over month. Core CPI, which strips away food and energy, 6.5% year over year. And core CPI decreases to 0.4% month over month. Here's the thing. If the CPI comes out at any point higher year over year or month over month, then I think the market continues to tank. And it won't be done tanking yet. There's still earnings around the corner, and we haven't even talked about earnings compression. So the way that I'm likely to play this is I will likely open up a strangle or straddle a day before the CPI comes out. Remember, the CPI comes out on Thursday. I will likely open this on Wednesday afternoon, right? For Thursday, and will likely end up closing it that same day. But a straddle or a strangle is where you buy a call and a put at the same time, expecting a large move in either direction. So when you buy a call, there's a linear trend line in terms of your profitability if the price keeps going up. And if you buy a put, there is a linear trend line in the opposite direction. So this is what a straddle looks like when you buy a call and a put. Now, a straddle is the most expensive type of option to buy. A strangle is a little less expensive, but you can see why. It's because you're taking bets on both sides of the market. So you need an extreme move in either direction in order for you to be profitable. And if that move comes on Thursday, on the CPI day, and the last CPI day, we actually saw a 4.35% candle on the S&P 500. If you get a move like that, then your straddle or strangle is very profitable. Of course, I will be sending this out in the Academy. So go ahead and subscribe. Link is in the description below. Book a free call with one of our ambassadors if you want to apply to the Academy. And also in the description below, you will find a form. And on that form is a sign up to a free Zoom call. I will be hosting a free Zoom call. I do a Zoom call every single month with the Academy members where I go over and answer every single one of your questions regarding options trading, futures trading, how to evaluate companies, day trading strategies, how to do option strategies, etc. I go over every single question that you guys ask me over a Zoom call. It's a very interactive and fun event. I will be opening this one up to anyone who wants to join, but it will be capped at a certain number because obviously Zoom calls can't just be an unlimited number of people. So link is in the description below. I want you guys to sign up to get a sense for how these Zoom calls are run, what it is we talk about, the topics that we discuss, how deep we dive into some of these complex trading topics. So you will see that link in the description as well. All right. And one of the data points that I wanted to discuss, which has never happened before, is if you take a look at the 20-year treasury bond, right? This is considered a risk-off asset, a long-term treasury. Never in our lifetime, never in history have we seen a drawdown in the stock market this large when we're going peak to trough, where the 20-year treasury bond has surpassed the declines in the stock market, right? So the 20-year treasury bond this year is down almost 30%, less than the decline that we see in S&P 500. This is the first time ever in history. The reason that this is important is because the bond market, one, is a risk-off asset, right? It dictates how bond investors, which generally have a leg up on what's going on in the economy before stock investors do. The reason is because bonds are considered a risk-off asset. The 10-year treasury is considered the risk-free rate, right? This is essentially guaranteed money that the government is giving you for giving them a loan. It's a much safer bet than the stock market. And the reason that it is usually better at predicting economic events, one, the bond market is a lot bigger than the stock market. And two, the stock market has a lot more hope baked into it. It is a riskier asset class. It is based on company growth, etc. So it's not always a good predictor of where the economy is because there is so much hope and FOMO and insane valuations that traders can actually, prop up the stock market or prop up certain stocks, and not really see what the economic risks are. Whereas if a bond investor is bearish, that is a very bad sign because that's telling you that the bond investor is not even willing to take basically the free bond yield, the free money, guaranteed money by the government, in exchange for holding their cash. They would rather stay in cash than invest in the bond. That is why this is very dangerous. And this has never happened before in history. And I think this is part of the reason is because we don't know how long the Fed is going to hike for, right? We don't know what the terminal rate is or the target rate. And also we have not yet seen earnings compression. Right now, the forward S&P 500 PE ratio is around 16. And we haven't even seen the effect of unemployment going up, of a softer labor market, of the bullwhip effect that price instability is going to have on retail. We haven't seen the major effects of that yet, right? Prolonged interest rate hikes. It takes time for these interest rate hikes to actually have an effect on the economy. So the thinking there is that the next round of earnings and the one after that is where we're going to now start seeing these deleterious effects reflected in earnings. So most analysts are expecting earnings to decline, right? So we have really no idea for how much earnings are going to be affected, when unemployment is going to start going up, by how much unemployment is going to start going up, and when is the inflation issue going to finally see a slowdown, right? See a real slowdown where we see light at the end of the tunnel, because right now we're not seeing it. And that is why I think you are seeing this sort of dislocation here in the risk off assets and treasuries, right? A dislocation that we've never seen before. And again, as I talked about before, previous recessions, the 2008 recession, the 2000 recession, those were largely unseen. Of course, a few people thought that they were, that a recession was upcoming. If you look at Michael Burry, always someone like Peter Schiff is going to predict a recession, but the masses didn't really see it coming. This is one of the first recessions, really since 1980, where this is preemptive based on the Fed actually hiking. So you can make an argument that that's the reason why we are seeing such a dislocation in the bond market, why we are seeing, these predictions of recessions, these predictions of economic turmoil, is because we see in real time the Fed is trying to actually break the labor market. The Fed is actually trying to cause a recession. That is why, right? It's because it's not an unexpected black swan event. We know what they're trying to do in real time. That is why you're seeing these paltry expectations here. So hopefully that makes sense. Anyway, traders, that is it for this video. We will likely be live streaming October 13th, at market open, to go over the CPI report, digest it. Again, I will likely play a straddle or a strangle on the S&P 500, maybe the NASDAQ, because even the NASDAQ is more sensitive to interest rate changes, right? If the CPI comes in hotter, either month over month, year over year, or both, the market is likely going to tank some more. Again, as always, I've been telling you on this channel, I'm targeting the pre-COVID highs as the next major support range, and I will likely be doing some heavy buying at that range as well. Let me know in the comment section what you think of this video. Are you buying anything? Are you holding out? Do you think inflation will come in higher, lower? What do you think is the expectation for the market and the economy in the future? Subscribe to the channel, sign up if you want access to the academy, hit that notification bell. Stay safe out there, traders. Peace.